Well, it's been a fairly active last 12 hours or so in markets globally. And what's really dominated the headlines is the FOMC minutes, which have been released by the Federal Reserve. Mind you, this was the minutes of the meeting of December of 2021, which have been released now. Of course, a lot of commentary around that meeting has already been released, but fresh commentary or fresh data from the minutes have led markets to react. And let's have a quick look at what was part of this minutes as well as what was already part of the earlier commentary which markets already had. Now, the committee decided to taper faster than expected to withdraw liquidity or rather to reduce liquidity in markets starting January of 2022, and all 18 members have expected to see at least one rate hike of 25 basis points through the calendar year 2022. The Federal Reserve plans to reduce its balance sheet, and that is the crucial piece of news which has come through. The Fed is now aggressively looking to dial down on its balance sheet. Mind you, an $8.3 trillion balance sheet is what the Fed is sitting on at the moment with treasuries as well as mortgage-backed securities. It's going to plan to offload some of them faster than expected. It's going to dial back on its pandemic era monetary policy as well. Fed officials have repeatedly said during the meeting that they believe the ultra easy policies instituted during COVID-19 as well as during the pandemic were no longer warranted or justified. Strong words coming in through the minutes. Committee members also expressed concerns over surging inflation while saying that they see the jobs market at close to full employment. Employment was one of the key factors which was holding back the Fed from tapering down on its bond buying program. So that too, getting some amount of clarity as to how they are viewing the jobs market. So of course, median number of members have seen or are at least predicting 3 rate hikes in 2022 and as many as 3 in 2023 as well. So sharp increases there, and despite both of these rate hikes, it may be likely that real interest rates in the US will continue to be in the negative, since inflation is well above 6% at least at the moment. So a mix of both selling or offloading its stock of treasuries and mortgage-backed securities as well as rate hikes will be the way forward in 2022 onwards for the Federal Reserve. This is what it seems like. All 3 indices as well as 11 S&P 500 sectors all ended lower in Wednesday's trade. The Dow fell over 1%, the S&P 500 almost 2% lower, and the Nasdaq down almost 3.4% in trade on Wednesday. Moving on to how the handover to Asia has been. Of course, the handover has been in the negative, and Asian markets too have opened in the negative, with the Nikkei down almost 2% as we speak. The Shanghai down 0.75%, the Hang Seng down 0.5%, the ASX 200 down over 1%, and the Kospi also down 1/3% as we speak. So not good cues coming in from Asian markets either. The SGX Nifty is also down almost 1% in early trade today. So clearly it's looking like a lower market today. When we look at how commodities have done, oil is still just above that $77 a barrel mark. Mind you, OPEC Plus plan to lift output, but despite that, oil prices seem to be quite steady, holding up above that $77 a barrel mark. Gold though fell almost 1% as bond yields rose, but gold is still able to hold above that $1,800 an ounce mark. So gold is able to hold out despite a rise in bond yields. The dollar index, which fell briefly below the 96 mark in trade yesterday, has rebounded. It's above the 96 mark, in fact 96.2 as we speak. Bond yields have risen sharply across the last 3 sessions. It's up almost 20 basis points. It's breached that 1.7% mark, especially after the FOMC minutes which have been released today. So a strong rise in bond yields. The 10-year yield above 1.7, 20 basis point rise in the last 3 days alone. Bitcoin fell over 5% in early trade today. It's at the $43,500 mark. That's a roundup of how markets are looking today.